All right, all right, all right. We are live. Hopefully the sound's good. I haven't been on a Zoom call yet today, so haven't been able to test the mic. Let me know if you're in the comments if sound is good. I'll wait for some more people to jump on, but I'm excited about today's show. It's always a freestyle. It's always live Q&A. And so I never know what we're going to talk about. It's going to be stuff about self-employed borrowers. It's going to be stuff about investment properties. Who knows? What I do know is that Matt, the mortgage guy team, had a busy weekend, tons of applications coming in. We got 6 new loans to submit today. So I'd love to talk a little bit about what got into contract. It's always interesting for me to compare some of the headlines and some of the stuff I'm hearing in the news and from other people with what I'm seeing and feeling, what's getting into contract and whatnot. Because a lot of the, real estate chat is around it being impossible to get an offer accepted. You can't do anything FHA. You can't do anything unless you're 9 million above ask. And I'm getting people in contract day in and day out. I'm not saying it's easy, but I'm saying it's possible. And I'm saying with a really good lender and a really good real estate agent, and I won't take all the credit. It really takes a good quality real estate agent in today's market to get an offer accepted. But with well-written offers, well-presented offers, agents who are communicating with the list side, stuff is getting accepted. I got real life examples. We can jump into them. So I'll wait for some people to jump on, fire questions at me. Once we get 40, 50, 60 people on, I might not be able to dig deep into every single question. So if you're on now and you're on early, go ahead and fire off a question and I can answer it in quite a bit of detail before we get moving and shaking where I'm trying to answer them real quick, in a minute or a minute and a half. Really enjoy these live streams. How many times can you use a 203K loan? All right, Ant, thanks for joining us. The ideal amount of times to use them is 0. and I'll say that with a grain of salt. Only written a handful of them myself, only had exposure to a handful of people in my office that have written them. And then I've gotten feedback from those loan officers and the clients that went through it. It's generally an expensive loan. It's a higher interest rate, meaning it's not only expensive in fees and what you pay loan cost wise, but it's also expensive ongoing until you can refinance out of it. And from what I've heard, it's just got so much rules and regulations in it. There's 2 different forms. There's a 203K streamline, and there's a full 203K. And I think if it's less than 30,000 in repairs and you don't need any major construction like walls being moved or foundation or whatever, it can be a streamline one, less than 30,000 repairs. And those are a little bit easier if you're moving walls or you're adding a second story, you're doing some major stuff and it's going to be over 30,000. That's a full 203K. You've got to use FHA's approved contractors, and you've got to pay them whatever they charge, which I've heard is more than your average contractor. And you've got to kind of wait through their process. And in general, like anything that has to do with state agencies and their processes, as many of you who have ever been to the DMV would attest to, just slow moving and a pain. And so I've never had anyone say that they had an enjoyable experience doing a 203K loan. Obviously, there's properties where they need a ton of work and you've only got a couple options: cash or something like a 203K loan. And so maybe in some scenarios, what I would recommend, and anybody that comes to me, this is the first kind of thing that I say, is don't use me. Don't use a guy who's only wrote 2 of these in 7 years. Don't use a guy who hasn't done a 203K loan in 3 years. Use somebody who does these quite a bit. I know some loan officers do a lot of construction loans, a lot of 203K loans, and I'll refer you to them in my same market with a different company. I just know that they're better set to serve you because they do it more, right? And so that's the best advice. I guess my final piece of advice is that I don't know enough to really give a good opinion, except for that I've never heard good stuff. And I've talked to some people. Let's say you find a property that needs cosmetic stuff, $25,000 in repairs. I think you're better off if the thing would go conventional, buy it conventional, find somewhere else to finance that 25K, use your own contractors, use your own, Home Depot line of credit or whatever you have to do to get those repairs done, and then refinance it into a new loan or something like that. Because with the FHA 203K, you pay FHA's upfront mortgage insurance premium of 1.75%. The 203K for sure comes with a higher interest rate. So there's a bunch of not so great stuff about it. Hopefully that answers it. What's up, Nate and Jess? Epic Travels. Man, hopefully a lot of people are planning some epic travels. I know me and my family are ready to get out this summer, do some stuff. We've been locked in the house long enough. Let us free. I think that most of the country's feeling that. So you guys, what kind of other products have you used, Nate and Jess? I know you guys have had some experience with real estate. I know you guys have chimed in and had some good feedback on a bunch of different stuff. So I'd be interested to know. You've never used a 2 or 3K loan, but what stuff besides conventional FHA have you used, and what stuff have you found to be good, and what stuff would you say I'd never do that type of financing? And that would be a cool thing to answer because I know you guys have some experience. Serena. How often are properties appraising at the offer price? And if appraisals are coming under offer price, what is the average gap you are seeing? I'm obviously not seeing a huge gap, but what I will tell you is that if your agent and the list side agent aren't addressing this up front, then your market's different than mine. Because let's just take an offer that I got into contract over the weekend. I took some notes just so I could talk about real stuff, right? And I won't use any names. I'm going to try to maybe even tweak the numbers a little bit just so I don't give anything away with current clients that may or may not be listening or following along. One that went into contract is listed at about 600, in contract at about 650. And they wrote that they're willing to pay up to $25,000 above the appraised value. Now, from what I've seen, I wouldn't be surprised if this thing came in at 625 or 630. It might even come in at 650 where it's in contract at. I've really seen appraisers kind of use this trending up market, and there might be comps at 630 and 640, and then they can get it to 650. But I haven't seen huge gaps, and this is hard to answer because I probably do stuff from 300,000 purchase price to 1.8 million to 2.2 million. I mean, I'm in California, so there's a big spread. So if I see a $50,000 appraisal gap for somebody who's buying at 300, that's a huge gap. For somebody who's buying at 1.8, that's expected. They offered 1.8 and they were willing to pay up to 100,000 above if it appraised at 1.7 or higher. So that $100,000 gap is different, or $50,000 gap, than in contract at 330 where they're willing to pay 20,000 above, or some of them are waiving it altogether. But I would say that the average gap I'm seeing is within 5%. And the ones that are the big gaps, I feel like it's expected. I mean, I don't know if I'm just a lucky dude. I'm working with smart real estate agents who know what's going to happen before it happens. And they write a contract so all the parties know, hey, we're going to write this offer at 460. It might appraise all the way down to 425, but the buyer's willing to pay whatever the appraisal gap is, up to 50,000 or whatever that number is, right? And so the appraisal gaps aren't as big as one would expect. As crazy as kind of the buzz is about things are going wild and crazy, the gaps aren't crazy. Why are housing prices going up in Vegas? Because of California move-outs? I bet you, Jay, if you look at the stats, I think California for the first time ever had a decline in, what was it? Not our population. For the first time ever, like our population's down 180,000 people or something. They're not all moving to Vegas. They're moving to Idaho and Tennessee and Austin, Texas, and all over the country. But Vegas's home price appreciation is the same reason there's home price appreciation all over the country. It's because there's just not enough homes for sale. There's 900,000 homes for sale across the country. And to have a balanced market, we need about 3.7 million. Because this year in 2021, more houses will be sold, something like 7 million versus 6.5 million last year. Yet inventory is down 53%. So we've got 53% less inventory and just as many or more houses being sold and more people wanting to buy because rates are low and there's just demand. And so that's why home prices are going up. And it's as simple as that. It's not that, people are leaving California because taxes are high and they're all going to Nevada and they're all going to Florida. They're all going to other lower tax states. That's part of it. It's a small part of it. The main component is very little inventory and a ton of demand, in my humble opinion. Michael Ocean, what are the advantages for getting a portfolio loan from a credit union versus the other options? I'm not sure what you mean by portfolio loan because there's tons. Portfolio basically means they're not writing to Fannie and Freddie. It's their own loan. So I don't know if you're talking about just, alternative guidelines and they're going to do a portfolio loan and do a 5% down jumbo, or they're going to do a portfolio loan and let you take 15 properties and have one loan on all of them. Clarify that. But portfolio loan, the advantages would be it's not something you can find elsewhere. And they call it portfolio because they're going to put it in their own portfolio. They're not going to sell it off to Fannie and Freddie. So everybody else who's writing loans, who's saying, hey, you need a debt to income ratio of 45% or less, and you need to make this much versus whatever the cost is, the mortgage plus your debts and the box you have to fit into, they can make the box whatever they want. And that's what portfolio means, is that we're making the rules because we're going to hold on to this loan. And so it might be they have a portfolio loan to 5% down jumbo. It might be a portfolio loan where they use 12 months of your bank statements versus going off your tax returns. Whatever it is, that's the main advantage of it, is that you can't find it elsewhere. It's their own type of loan. All right, Nate and Jess, I asked for it. You gave it. First home was 30-year FHA, refinanced to 15-year conventional. Later also did 30-year conventional, 30-year investment property loan. All right. Yeah, that's what I'm talking about. Smash that like button. I think we're about 75 subs from 6,000 subs too. So if you're on here and you're not subscribed, get with the program. What's up, Paul? Glad to see somebody from SAC. Appreciate having you, man. Let me know if there's anything I can answer for you. If you're in the market for real estate, let me know. Let me know what you're seeing out there. It's wild, but I'm telling you, six people got submitted today. We got people in contract. It's not impossible. And these aren't all SAC, I guess, either. I'm looking at it. I took some notes so I could share tonight. Some of them are Granite Bay, Folsom, some outlier areas where some of my folks are getting their offers accepted, but they're getting accepted. And as hard as this one is to believe, I got one accepted. It looks like about 5% below list price. People are going to fall over backwards. It's a good house in a good neighborhood in good condition. It might not be. And see, here's the thing. Here's where people get all caught up on list price, right? I paid this much above or this much below list price. List price is just a number. This place, I haven't dug into it to see, but it was either mispriced or something, because I haven't even done research on it, but it sat on the market for 39 days. In this market, if you're on for 39 days, you ain't priced correctly for what you're selling. And so my client, I think, got a really good deal. Got a 5% below list and $10,000 in seller credit. This I don't want to give too many details, but you price it more correctly. You get it sold in 4 days, and you get it sold at or above where you list at. It's probably more than this price they got it for, but I don't want to get too detail oriented on real life deals, because then somebody might realize, oh shoot, that's me. Nate and Jess, the minimum amount down for a second home vacation home loan, 10%. And it's still 10%. If anybody remembers that announcement that was it within the last couple months, where Fannie and Freddie said 7% max. Lenders that send us loans, 7% of them maximum can be investment loans and second home loans. And so there was all this fuss. I made a video because there was fuss about it, that prices were going to go up and guidelines were going to get harder for second homes and investment homes. Well, what happens is the lenders that were doing a lot of those had to do those things. Pricing adjustments and guideline adjustments, making it harder. Those who weren't doing a lot of them were like, we're fine. We're doing 4%. I mean, we've got room to do more. Bring them on. And so a couple lenders I really, really like, nothing changed. Small little 25 basis point loan level price adjustments. And so they're still great terms. I've got one in contract and I think it's right around 3%. I don't need to look it up. Plus or minus 295 to 3.05 with 10% down on a second home. And I'm not sure, the credit's probably 700-ish. So yeah, great terms on a second home. And that's really popular. That's part of the reason. I was talking to somebody the other day. That's part of the reason why we continue to have the problems we have with inventory. Because the people that are buying new homes and second homes, they're not selling the one that they're leaving. You know, I know people that are from SAC, business in SAC. Hey, I can work remote. I'm going to buy a Tahoe house, or I'm going to buy a house in Pollock Pines, or I'm going to buy a house out here, and my family's going to move there. I'm going to work remote. I'm keeping SAC. I'm not selling it. And so houses are being bought and people are moving up, down, sideways, but not selling the house they're leaving, causing more supply constraint. What price range was that price? Oh, for the 5% below that, that's about $600,000 was that price range. And so for that area is probably the average. You know, I don't think you're going to see 5% below list price on the entry level stuff, which in Sacramento is 300 to 400. Used to be 2 to 3. And long gone are the days of sub $300,000 homes in Sacramento, even in some of the rougher parts. You're seeing homes 300,000 plus. Drive NYC. Thanks for joining. Appreciate you. Appreciate everyone who's joining. I don't know how many likes we got after my friends Nate and Jess asked to smash the like button, but I appreciate all of them. I purchased a home for $645,000 with 20% down in December 2020. I watch YouTubers like Chris Crone and a few other investors. When do you think I could pull out some equity to purchase an investment property? It's a good question. So you bought it for $645,000, and 6 months later, you're thinking about pulling out equity. Here's the thing about pulling out equity from a property. Some YouTubers or some people that are, trying to get people excited about real estate. I'm excited about real estate and I love real estate, but real estate is not like a get rich quick thing where it's like, buy this property, pull out 90,000, buy that one. 6 months later, pull out 50,000, buy this one, and have 15 properties worth 10 million in 5 years. I just sure that there's probably one story like that, but it's more common. Let's say you bought for 645. We've seen a crazy run, right? Where this thing could be worth 700,000 6 months later. That would be a 10% increase, which is wild in any market and not something you're likely to see very often, right? But if it's worth 700,000, you're still limited to 80% loan to value on as far as how much you can pull out. Sure, you put 20% down, so you put down, what is that, about 130 when you bought it, and so you've got that 130,000 in equity, but it's not something that you can just pull out. No lenders are going to 100% loan to value anymore. They did back in 2006, but let's say it's worth 700. So a lender's going to allow you to do a cash out refinance, and they're going to cap you at 80% loan to value, 560,000. Well, you owe 515-ish based on the fact that you put 20% down. And so you've really only got title fees, lender fees, setting up the escrow, all that stuff in there that's going to be loan costs. Between the 515 and 560 loan costs aside, maybe you can pull out 40,000. That might not be enough in the area where you're at. If you're buying it anywhere near that 600,000 mark and you're trying to buy an investment property and put 20 or 25% down, the 40,000 you can pull out of this property is not enough. And I would not recommend, which somebody's, rebuttal to my, you've only got 40,000 that you could pull out is, take a home equity line. You might be able to go up to 90%. I saw a product. I get all this stuff all the time from different wholesale lenders. These guys go to 97.5% on a home equity line of credit. Never in my wildest dreams would I tell you to do that. It's something like 8.75% to go that high. And it's adjustable with an 18% lifetime cap. Like, don't ever do that. I don't even know if I'm signed up with this lender. I just printed it out just for good laughs. So with that being said, you can get 40,000 out in your 80% loan to value. Maybe you can even go another 60 grand if you did a 90% loan to value home equity line. But that's a slippery slope, right? That's where you get into really highly leveraged, highly risk real estate where I'd be careful. Is probably my final piece of advice there. Finally got an accepted offer on a house. You got an accepted offer on a house. You don't know what lender you're using? Well, that's part of the problem. Get that stuff dialed in beforehand. I think I did a video on like when to choose a lender. And I don't want to pick on you, the TAM. I want to give you good advice. When you're shopping for a home and you're talking to lenders, a lender that you like and trust, and it sounds like from what you're reading about, tons of serious customer complaints, find somebody who has really quality reviews because they've got a reputation to protect. If you're working with a big online lender, no reputation at all to protect. And that's why they've got serious consumer complaints because they've got a big online lender. The guy's working in a call center. Sure, you can look up his NMLS number and whatnot, but they're not working on referral. They're just working on incoming leads, which leads me to something too. I wanted to ask a question to the masses. Oh, you dumped your lender. What happened? All right, let's hear the drama. Thank you, Drive NYC. I appreciate the $199 super sticker. Serious points in my household with my kiddos for getting the super stickers. The more super stickers I get from you guys, the more dad swag I have with my 8 and 10-year-old. Old 40-year-old guy like me who sometimes gotta prove he's cool to his kids. I come home and tell him, yeah, Dad, got some super stickers on the live tonight. That's some good stuff. So let's dig into this one, Tam, because this is what the internet wants. We want to hear some drama. You had a lender and you dumped her. Tell us why. And it'll be a good learning experience for me as a lender on reasons why you might get dumped, and then for others on what they can do and whatnot. While I'm waiting for you to tell us some of the drama, VA loan lender, any broker that you get with can do great VA loans. And I've got a handful of lenders in the wholesale world. As a broker, I'm honest with people. And I say there's certain products where maybe a big bank can do as good or better price wise, and maybe a direct lender and a broker are pretty close. I know for certain with VA loans, brokers absolutely crush everyone else on price. So with that being said, here's where you go. I'll pin this somewhere, but I've got a link where you go to this 6 quick little questions, and they'll connect you whatever state you're in. If you're in California, holler at your boy. If you're outside of California, greatmortgagebroker.com, and they'll be able to that'll connect you with whatever state you're in. One of the 6 questions will be what state you're in. You'll connect with the great broker in your state and get you a great VA loan. VA loans, when you're VA eligible, are amazing loans. Low 2s on a 30-year fixed. No mortgage insurance. Very good looking loan. Another loan that people think, is impossible to get accepted in a market this difficult. I got a couple VA loans going right now. Piece of cake. Just takes the right property and the right seller and the right agent on the sell side. But if all those things are there, I'm really interested on this lender dumping. Oh, there we go. Didn't want to explain things, filled out wrong things on our app and told us to sign anyway, had a bad attitude. Yeah, I mean, I think that is definitely something, when you're dealing with buyers, the last thing you want is them to be confused or feel like you're not paying attention to details and whatnot. And so yeah, I totally understand that. But now that you're in contract, I would say sooner the better. Find someone you like and trust. And the great thing about 2021 is there's so much information online. If you're in Gilbert, Arizona, I have no idea where you're at, I would go to Gilbert, Arizona mortgage brokers, something like that. Just Google that, right? And just find somebody who's got 37 Yelp reviews or 25 Google reviews. That person is going to do a good job for you, because if they don't, they're going to screw up their online reputation. And I mean, that's the leverage you have. If somebody calls me and I'm going to do a loan for them, I can't do a bad job. I've worked too friggin' hard to build a great reputation where if a big online lender screws up, you'll be lost in a sea of 77 bad reviews. You don't even know who you worked with, right? Because it's just somebody in a call center. But a local mortgage broker with an online reputation, more important than ever in 2021, like that's who you go to, because they've built that good online reputation by doing right by people, not doing this stuff, having a bad attitude, not explaining things. And so yeah, that's my best advice to you, is do that. And probably, you don't have to interview 7 people, find 2, call them both, see who gives you the best vibe. I have conversations with people every day, and I basically tell them how we operate, things I think we do well, why I think they'll enjoy working with me and my team, and then let them know if you want to get started. I'll send you a link to our online application. Be happy to help you out. But ultimately, it's their decision. They might talk to somebody else who, for whatever reason, is their cup of tea, and I might not be their cup of tea. But find your cup of tea, Tam. Best of luck to you. I got an offer accepted using B of A because they were giving me $11,000 in grants. Appraisal was 8 days ago. Oh man, with B of A, it should only take 9-10 months. You'll be good. I'm sorry, I couldn't help myself, Darren. Appraisal was 8 days ago. So if they appraised the house 8 days ago, it's not unheard of to not have the report back, because appraisers are super busy. And so they'll do it. And then, let's say they did it on May 5th. The report is going to be back May 12th. I would start to lean on the loan officer. And even though it's a bank, if you have a good loan officer at that bank, then you'll be okay. But lean on them to say, hey, can you send a message to the appraisal management company and ask them where the heck this report is? Because they did it 8 days ago. And they did it back on the 2nd. And I'm wondering where the heck that appraisal report is. So just stay on them politely, right? I've got clients that we're looking at every single file every single day. So I never have anything that falls through the cracks. And so I'm stressing about just as much as the clients are. But when clients reach out to me like, hey, Matt, have you heard anything? Have you heard anything yet? I don't get upset. No, I'm sorry. I'm frustrated as much as you are. I've sent 2 messages to the appraisal management company and they promised me it's going to be back on the 12th. So ping your loan officer, ask them when it'll be back. It doesn't usually take that long. It's probably like 5 days after the inspection where the report is turned in, but it really depends. There's appraisers that get an order on Friday, they inspect it on Sunday, and they turn it in on Monday. And there's other appraisers that they don't turn the report in for 10 days after they do it. But generally, with most appraisal management companies, how it works is an order goes out and I've got somebody in contract. I need an appraisal back in 12 days. Somebody accepts the order and says, I can do it for $475 and I'll have it back on May 22nd, 12 days from now. And they'll go out there and they'll inspect it next Monday on the 17th. And then they've got those 5 more days to turn it in. And so they'll have like a due date when it's due. And that's how all my stuff works. I think it should be the same. Banks are using appraisal management companies just like brokers are. So it should be something like that. All right. I'm glad that was helpful. Thoughts on rent to own? All right. I'm glad you could join as well. Thanks for the support. I feel like, was this the one we were talking about last week where my friends Nate and Jess chimed in with some good advice? I feel like we did. We touched on the rent to own because there's some definite positives to it where you can buy a home that you otherwise couldn't, and you're not competing against 20 offers. But the risk, I think, and I've got a buddy, Ryan Nickel, who's like a master at this stuff. I should get with him. My buddy, Mike Zuber, has a seller financing portion of his real estate course where I'm pretty sure he got with Ryan Nickel and they went into detail on this with seller financing, which is similar, right, to rent to own, because you're working with the seller to a lease option or something to buy it down the road. If I remember correctly, the advice from Nate and Jess was talk to a real estate attorney, have them review the contract. That way you don't step into a big piece of doo-doo. Because what can the negative about it, and something that could come out bad. I live near an Indian casino, and there's a bunch of folks who are part of this tribe who get $30,000, $40,000, $50,000 a month being part of the tribe. And I have heard through one of them that I worked with on a mortgage that quite a few of them were taken advantage of on these lease to own options where they put huge down payments down up front. And 2 years later, 3 years later, whenever that lease to own option came due, it was like, you got to buy. And if you can't, you're out, and your huge deposit, huge down payment is gone. And a lot of these people didn't have the credit to buy. That's part of the reason they were doing the lease option. And the seller didn't want them to be able to buy. The seller was hoping that they wouldn't be able to buy. And so these people who got into these $600,000, $800,000 houses was 20% down because they get all the money from the tribe, right? And so they had $100,000, $150,000, $200,000 down payments. Boom. And they're paying big rent payments, which were at market or above market rents. And the promise was, well, some of your payment is going to go towards the principal and it's going to pay down. You're going to owe even less when you buy this place. Well, when you can't execute that option to buy and you lose $150,000 deposit, and you might have been, in a contract where you're going to buy it at $800,000, it's gone up to $950,000. The seller is hoping you can't buy it, right? Oh, you got this much time, you can't buy it. Okay, sorry, you got to get out. That would be a risk, right? So avoid that at all costs. Oh, there we go. See, I didn't see this, but real estate attorney review any proposed rent to own seller financing agreements. Yeah. And that's the thing. Whatever it's going to cost a couple $100 to have a real estate attorney review it is worth not losing $30,000, $40,000, $50,000 or whatever it is. Because I haven't seen many of these where a seller's willing to do it without a fairly sizable down payment. They want you to have skin in the game. At the very least, $10,000, $15,000, $20,000. Otherwise, they just sell it, I think. All right. You know what I was going to get into? If we don't have any questions for the moment, Ryan Lundquist, SacramentoAppraisalBlog.com. You guys have seen him on the channel. He put out a good blog. And it's back to this, just everybody assumes that everything sells 9 million % above list price. He broke it down by price range in Sacramento County. And so the stuff that he puts out is Sacramento. So if you're outside of Sacramento, sorry that it doesn't pertain to you, but average percent paid above the list price, it's pretty consistent from 300 to 400, 400 to 500, 5 to 625, 625 to 750. That whole 300 to 750 band, it's like 4% above list, between 4 and 5%. Let's see if we can see that on here. This is the old school way of sharing your screen. If I was really techie, that would be like a share screen type deal. Oh, I probably could, huh? There it is. No, I'm not that good at the tech. Catherine G, appreciate your support. Appreciate seeing you. Always contributing with comments and checking out the videos. So thank you so much. Glad you could catch me live as well. 6 to 9 months out from the beginning of the process. I know you're out there in Illinois. I know that you're connected with a great broker out there who will take great care of you. 6 to 9 months out, here's my best advice, is you've got all that time to educate yourself on exactly what your mortgage is going to look like and the market. So here's what I would do if I was you. I would, if you don't get one from the broker you're working with, I can send you one. Let me pull something up real quick. Because I send this scenario template to folks, and it lets you just kind of mess around with, what'd I do? It lets you mess around with different price points. All right, this will be an old one, but let's see if I can share it and if it's big enough for everyone to see. Because I'll tell you what I tell clients that I'm working with, what they should be doing. One, you're looking in whatever market you're going to buy in, and you're finding out in the price range that I'm looking at, how long is it taking for things to sell? What are the things that I like selling for? All the stuff that really, as an agent you're working with can send you stuff. With the internet nowadays, you can really do a lot of that, your own research. And so I've got an app that just tells me whenever a new listing is available in the zip code I live in, just because I'm interested in that stuff, even though I'm not necessarily buying. And so I would do that for where you're looking to buy. Let me see if I can figure out how to share. Share screen. Oh man, let's zoom. So here's something that I share with clients, and let's say that you're buying 400,000 with 20% down. Go out there and look. I have this essentially look like a loan estimate where it breaks down all the fees and everything. But there's your estimated cash to close, $89,960, assuming you're paying all the transfer taxes and all the fees, right? And you're putting 20% down on 400. This Excel spreadsheet, when I send it over, you start looking, you realize, you know what? 450 is the range. It's probably what I'm going to end up paying, because the stuff I like is 450. And you just type that in, and then it repopulates. Okay, my payment is $19.97. This property tax estimate is going to be different. It's 1.25% for me in California. It might be different for you in Illinois. Homeowners insurance might be different, but it's pre-populated for my market and for my clients. But if you had something similar, then you can say, okay, that payment's going to be $19.97, and it's going to be about $100,000 cash to close for that scenario. And by messing with this and looking in your market and over time, you get a really good feel for, okay, I'm going to target 440 to 460 because it's a little bit nicer neighborhood than the stuff I was looking at 400. Or maybe over time, prices get more expensive and you've got to look at 460 to 480, whatever it is, right? You're just getting really comfortable with the price range. And, this was from December. Maybe rates are 2.875 now. Maybe you even want to put in 3 1/8 just to account for if rates tick up a little bit. But whatever it is, this just gives you a good feel for what to expect on a monthly payment, what to expect on a total cash to close. So you'll be light years ahead of probably half of the clients that get pre-approved on Friday, look at houses on Saturday and put in their offer on Sunday, and really haven't even looked at anything like this. They get in contract and then go, oh, my payment is, they're in contract at $625 and they qualify, but they're like, oh my gosh, my payment's $2,800 a month. I didn't think it would be that high. I saw some stuff on Zillow that was calculating things different. Well, yeah, because Zillow wasn't accounting for $650 a month in property taxes. They just giving you the principal and interest. They want it to look good, right? Or they were, 30% down or whatever it was, right? But know these numbers so that you're not sticker shocked when the time comes and holy cow, $2,800 a month. I didn't realize I'm paying that much. Well, by doing a little bit of this work, a little bit of these exercises beforehand, none of it's a shock, right? You can see all this and okay, title fees are this much, 1055 from the lender. My appraisal is going to cost about this much, transfer taxes. And then you get your initial disclosures. You're like, Matt, it's $3,000 less. Oh yeah. The seller's paying the transfer tax and they're splitting the cost of, the owner's title policy. Because some of this stuff might be split by the seller, might be paid for fully by the seller, depending on the market, depending on the property, depending on the contract, all that stuff. But looking at this like worst case scenario where you're paying everything isn't a bad idea, in my opinion. That's why I have all my clients look at that and mess around with this stuff. And it's editable so that they can look at different price stuff. And they look at one property in the 575, 20% down, like 2,600. Okay, well, what would that be if I looked at a property that was 640? Because the one that's 640 I love, and it's 2,900, so it's $300 more per month. Then they sit down with their significant other. Can we do 2,900 a month? Our rent is 2,650 right now. You're getting paid more than you were last year. I'm getting paid more. We're comfortable. 2,900. We're good with this, right? And then that's just the stuff that people don't do enough. And that's what I recommend you do, like everybody, right? With you having 6 to 9 months, Catherine, you just have all this time to do these type of exercises and get really comfortable with whatever you're going to get into. So that's my best advice. Hopefully that was helpful. When is the spring summer inventory coming on the market? Oh, guess what? It's coming, Zeta. I recorded a video today. It'll be out tomorrow. Let me see if I can pull it up here. I'm telling you, I'm feeling it, Zeta. It's coming. My buddy Mike Zuber says 2 million listings by the end of July. He might be a little bit more optimistic than I am. Maybe it's not that much, but I feel like it's coming. And I'll show you what the experts say, because I'm just some guy on YouTube. But the experts think that it's coming. And whether that's people are more comfortable to move because of vaccinations or whatever it is, they feel like it's coming. Where is that May edition? You guys will get a sneak peek into. I did like an 18-minute video today that's going to come out tomorrow, and I'll share this right now because it's inventory as of right now. Oh, that was March. Where's 900,000? All right. You want the answer to your question by some economists? Survey of economists. Here we go. When is inventory coming? Why is it blinking like that for everybody? That was weird. Gave me vertigo. Share. All right, now it's not blinking. So when will U.S. housing inventory grow again? 10% of economists, and I don't know, this survey is from Pulsonomics. I think the first half of 2021, that ship might have sailed. We only got 6 weeks left for these guys to be right. Probably not coming. 43% think the second half of 2021 is when U.S. housing inventory will grow again. And this is probably banking on people just comfortable listing. Little bit more turnover, a little bit more move up and whatnot. So between this and this, almost 70% think it's either the second half of this year or the first half of next year. But inventory is on the way. That's my story, and I'm sticking to it. I'm an eternal optimist, so I gotta believe it's coming. I feel like it's. I feel like something is happening. Something's in the air. Like I can feel it before everybody else does, where more offers are getting accepted. You know, and of the 85 or 90 fully pre-approved buyers I got, a greater percentage of them are having luck. That means something, right? Agents are getting better at writing good offers. I got to have some cold turkey meatloaf. Excuse me while I have one bite of some turkey meatloaf. All right. Catherine, I appreciate you. $2.99 super sticker. Much appreciated. More bragging with my kiddos. Shop around for FHA first time loan. Home I want is $130. With FHA, you know, you putting down 3.5% or 5% or 7%, it's really not going to move the needle that much. You're buying a home for $130, and a big part of your payment is taxes, insurance, and then what is that as far as balance goes? $130 times 95. So you're borrowing $123,500. I bet for every extra $1,000 you put down, you're only saving $4 or $5 a month, which just doesn't move the, let's say that your payment is $650 and you're trying to get it down to $600. You'd have to put an extra $10,000 or $12,000 to get it down there, which probably isn't worth it. I think it makes more sense to put 3.5% down and use the extra cash to pay off credit card debt, or do whatever you can to get that 659 credit score up to 700, 720. Over time, you're going to pay your loan down. Hopefully the home appreciates in value. 2 years from now, your home's worth $160 and you owe $115. And then you're in a position where you can refinance to a conventional loan and get the mortgage insurance to come off. That's going to save you $80, $90, whatever mortgage insurance is on that $123,000 loan. But I don't think that you're going to see a big difference in lowered monthly payment by putting a little bit more down. A couple $1,000 more down is really only going to change your payment by $4 or $5, $10 for a couple thousand. So that's my best advice. The national interest rate. What the heck is the national interest rate? If you're looking for like the average interest rate for a 30-year fixed, it's probably right around 3%. Whenever I look at some of these numbers, they take like a big poll of all the lenders, and it's always over an eighth above what my rates look like as a broker, which I'm not mad at. I love that it's higher, because then people call me and they're like, oh, 2.88. I'm like, yep, well, broker. We got thinner margins. We got better rates. Come on down. Mortgage News Daily. Who does? I know there's a couple sites that do like daily mortgage rate survey on Mortgage News Daily. They say 3.03%. If you've got great credit, you're probably 285 ish with a broker. So if that's what you're looking for, just like a average, then right around 3%. Call it 3%, depending on loan size, credit score, down payment, all that fun stuff, right? Mortgage News Daily is a pretty cool site. You should check it out. They've got cool news. They tell you, like, mortgage apps, whether that's up or down, refinance index, purchase index, building permits. Wow. Oh, that's like February's number. See, building permits and housing starts were down 10% in February. It's like before the pandemic started, we were building more than we're building this year. Like, builders got to get to it. Let's go. Build some homes. People are ready to buy. Just because lumber's 3 times what it was last year, and states are charging more for permits and everything else to do with construction doesn't mean you shouldn't be building. Get to it. Not holding your breath for more inventory. Oh man, that's for anybody who doesn't know what Nate and Jess are talking about with Invitation Homes. This is something that is scary. We got a serious lack of inventory. We need single family homes for people to purchase as owner occupied homes. And like I was just talking about, builders need to build. Well, sometimes builders build. And in this case, they built 124 single family homes in somewhere in Texas. And rather than create a sales office, pay sales agents, have a model home, if people walk through it, oh, you want to pick your model? Here's yours. 425. Here's yours, 435. Oh, you want some upgrades? 440. All that rigmarole. Invitation Homes said, you know what? Let's just put this 124 home lot up for sale. Let's skip all that individual sale stuff. Let's just see if we get a good price for it as a whole. And then you know what happens? Just like individual homes get bid up. Got bid up. I don't know what the number was. I think it was like 32 million. So they sell it for 32 million. Here's the scariest part. Their profit on that development was like 2 or 3 times what their average profits are when they sell them individually. I mean, builders aren't nonprofits. So if they're making 3 times as much doing it that way and just selling to an institutional investor that's going to buy them all at once, who do you think they're going to sell to in the future? They're going to build. And mortgage brokers like me, real estate agents and buyers are like, all right, cool. Builders are building. Look at all the building going on. If they sell it to Invitation Homes, or if they sell it to an institutional investor, then investor turns around and goes, boom, 124 rentals for rent, not selling. That is scary stuff. That hurts. Oh, so let's hope that doesn't become a trend. More inventory. That's good. Still selling quick, but it's coming. All right, Catherine, I want to hear more of that. I want to hear more inventory. I think you're talking to above with going conventional instead of FHA. Depends though. If they've got a 659 credit score, and if there's any issues qualifying, FHA is going to be more flexible qualifying. Maybe that they can't qualify at 130 conventional because it's a little bit stricter, and putting 3% or even 5% down conventional, that mortgage insurance is going to be double what it would be on FHA. So I'd look at them side by side. Sub 660, you might be better FHA. That's my guesstimate without looking at it, but put them side by side. Have a mortgage broker kind of look at it side by side. Whenever you can go conventional, you want to, because you don't want to pay upfront mortgage insurance and have mortgage insurance for the rest of the life of the loan, be kind of forced to refinance out of it. But in the sub 660 range, especially if it's you only qualify for 110 conventional and you can qualify for 130, and that's really what you want to buy in the area you're looking, then maybe it's makes sense to do FHA as a starter. Oh, you're 659. Well, Since we're talking about it, let's do this. 659. And let's do 5% down because it's going to be a little bit better conventional 659 with 5% down. 3% down conventional 659 is going to be pretty dirty. But I'll price it. My buddy DM, and then we'll just look at them side by side, conventional and FHA. This is not an offer to loan, or this is not an offer to lend. This is not anything. This is just some guy on the interwebs, happen to be a mortgage broker, NMLS number 1088993. Pricing varies by zip code too, so this pricing wouldn't even apply to you wherever you're at. But this, I'm just going to give you ballpark. I'm not even going to give you the true pricing. I'm going to give you ballpark. Purchase 5% down. Sales price of 130. I think that's what you were looking at. We'll do conventional, FHA, and I'll just side by side them. FHA is going to be about 2.6. Mortgage insurance is $81 a month. And I'm saying 2.6 with no points. Obviously, you can go to 1.75 and pay a bunch of points, but it's not recommended either. And then conventionals 3,375, and the mortgage insurance is 124. So that's what I was talking about, Nate and Jess. It's like between the higher rate and the higher MI, principal, interest, and mortgage insurance, not tax and insurance. 675 on conventional and 585 FHA. So it's $90 cheaper FHA. That's why I think 659. You probably go in FHA, and the 1.75 up front. While it's not very fun doing FHA on this small loan amount, it's $2,500 or $3,000. Not the worst thing in the world. I guess it depends on how long you're going to stay in it, right? Yeah, take that into consideration. Up front, 1.75. Oh, 1.75. Yeah, it's like $2,100. So you're going to save $90 a month going FHA. It's like a 24-month break even. And you got to consider the qualifying part too. If you don't qualify for as much of a loan, conventional, then you might go FHA for that reason. It's a close one. And that's where a good quality mortgage broker is just going to give you those two options and put them side by side and say, you know what? At the end of the day, I can't tell you which one to do. $90 less per month, FHA. $2,100 in upfront mortgage insurance is rolled into your loan. So you get that charge up front, but you pay $90 less per month. Mortgage insurance is on there forever until you refinance out of it, but it's only $81.50 a month. If you go conventional, your rate's a little bit higher, and your mortgage insurance is $124.50 a month, but it'll fall off once you get to 80% loan to value. Close, very close. I think I lean FHA. Another thing to take into consideration, maybe in your market, it's impossible to get offers accepted FHA. Well, if you can't get an offer accepted, then any loan is a good loan. So go conventional. I'm going to have a green pea while I think about it. All right. Great question. I like that analysis. I think that's good. I read you can do loan modification while in forbearance to increase the monthly payment. It's better just go out of forbearance and refinance. See, a lot of people are still thinking you got to make 3 consecutive mortgage payments coming out of forbearance. You don't. Almost every lender I work with, once you're out of forbearance, you're good. I can refinance you. You're out of forbearance. First payment is due on June 1st. Let's go. I'll refinance you today. Or no 3 payment minimum with most any lender I'm working with right now. So here's what you got to look at. Talk to your servicer, because I've heard tons of different stuff from tons of different people. A client of mine had their servicer straight up say, we'll take you from 3.875 to 3.125, and we'll do a 40-year loan. I told her, sign that paperwork now. It's awesome. It's a great deal. Somebody told me today that their servicer is telling them if they do a loan mod, it's going to take 60 days. And in the meantime, their credit's going to get wrecked. I don't know if that's true. That doesn't sound right. That's the hard thing, man, is you're going to hear so much stuff from so many different people. You don't know what to believe. I can't believe that they would do it like that. But see what loan modification terms you can get. So if you can get sweet loan modification terms, go for it, dude. Even as a mortgage broker, where I'm like not going to get a loan out of it if you don't do a traditional refinance. Use the fact that you have options to your advantage. Hey, if I do a loan modification, what is it going to look like? And from what I've heard, they're doing it just like they did loan modifications 10 years ago, where you'll enter into loan modification, you'll make 3 trial payments, and once you've made those, then it'll become official and you'll officially enter into this modification. I don't think it'll have any long-term effects on your ability to finance future stuff. Like it won't have a ding like a short sale or anything like that, but make sure of all that stuff before you enter into it. And then if there's no attractive forbearance modification options, then you exit, you refinance into a great rate. Just know that you're able to qualify for whatever mortgage you're trying to get into. Because some people, that are affected through the pandemic and their hours changed or their income changed or something like that, are having a hard time qualifying. Where that new program is supposedly out this summer, where they're going to allow people to qualify at higher debt to income ratios, that might become a cool option. So I almost forgot about that, but let's keep an eye out for that program, whatever the heck that was called. It's supposed to be coming out this summer. Lumber up over 300%. That's just crazy. Crazy. What's up, Mark? I was on your stream, man. You were talking about self-employed borrowers. I was in there listening. I didn't have enough time. I was trying to heat up my dinner before we got started here and do some other stuff. So I didn't get to pop in and say hello, but howdy, man. You must be done now. Now you're popping on over here. What's up? What's up? Kyle Seagraves, win the house you love. In the house. We got to do one together soon, man. You let me know anytime. I'm ready. If you want to pop on tonight, jump on in, man. Grab that link. Let's go. Thank you, Ludi. I appreciate you. I know you're up in Canada. You got some different stuff going on. And even though, some of the lending stuff is different, I got schooled up this weekend in the comments of my YouTube channel because I was talking about the fact that no loans have prepayment penalties. And then somebody up in Canada schooled me. He's like, no, up in Canada, we definitely do. You can't prepay on your mortgage. And if you pay it off early, you get penalized for it. So I appreciate the heck out of people correcting me and kind of schooling me up when it comes to differences across the world. Because it's just kind of neat, right? To learn about how things are different parts of the world. Definitely, Canadian mortgage different. What's the best interest rate you have seen lately for 30-year fixed conventional on investment single family home? I think they're in the mid 3s. But this kind of question, whenever I get something like this, like what's the best interest rate you've seen? I'll show you the best I've seen. I'll show you the rate sheet. Basilio. No matter what, if you want to pay points, if you're willing to pay points, you can get a sweet rate. I think Basilio is going to buy something for 400 grand and put 25% down. You can buy an investment property. I'll show you. Show you a sweet rate. Probably Yep, 2%. I'll give you 2%, Basilio. It's only going to cost you 23 grand in points, 7.9 points up front, but it's out there. It's available. And I mean, I think that's the thing is that par rate without paying points 3.39. So that tells you, man. I mean, investment property loans are still smoking. For anybody who wants to know what a rate sheet looks like, 25% down investment property loan, great credit. How do you do this? Control plus for zooming in? Alt plus? I need like a tech person on the team. There we go. $3.39, 0 points. 3%, 1.6 points, 5,600 in cost, right? So that's what it looks like. That's pretty good. People are like, oh, investment property loans are super expensive. Nah, 3.39% was 0 points. This middle right here is the points you pay. And really, like 13.28 is the principal and interest there. You go to 3.25 and you pay 1,760 in points to save $23. That's probably a 70-month break even or something. You wouldn't do that. I mean, unless people are like, I'm long-term. Stop screen. Long-term hold, never selling that property. Want to keep that forever. Need to cash out refi soon on one of my homes. If you're in California, you know where to find me. If you're outside of California, greatmortgagebroker.com. That's where you go. Yeah, I'm with you. I'm with you, Nate and Jess. FHA, unless, you know, you want to hedge against rates going up and going to be there for a long time. I wouldn't. I'd go FHA on that one we're looking at. Oh man, have you seen my video on velocity banking, DL? If you're a fan of velocity banking, you don't want to hear my opinion. It's just like, I made a video on how to pay off your mortgage in 9 years without using velocity banking, because their whole premise is that like the HELOC and the velocity banking is some magic friggin' pill. We're going to pay off your mortgage 1,000 times quicker and you're going to pay so much more less in interest. The idea of velocity banking is that you've got $8,000 a month in income coming in and $5,000 in expenses. So this extra $3,000 is going towards the principal on your mortgage. And then next month, $8,000, you're only spending $5,000. $8,000, you're only spending $5,000. If you did the same thing and just applied $3,000 extra towards principal every month and didn't take out a HELOC and didn't take the risk of the HELOC rate adjusting or spending more than the $5,000 and that balance even going higher, you would accomplish the same thing. And the whole like, well, it's compounded daily versus monthly, and it's like, it's such a minute difference that I'm just not buying it, dude. I'm just not a fan. Especially how it's pitched. It's pitched like it's the greatest thing ever. And like it's gonna be some like, you're gonna pay off your loan in 7 years versus 30 because you use velocity banking. You're paying it off sooner because you're applying more towards principal. Like that's the whole reason you were doing it. Is because you're putting 8,000 in and only spending 5, and then putting 8,000 in, only spending 5. That's the reason it's paying off so quick. That's why all the charts and all the velocity banking gurus out there can claim crazy stuff like pay off your mortgage in 5 years or 7 years. Well, of course. You're paying quadruple payments every month. You're paying $3,000 extra every month. All right, I'm done. All right, Basilio. These are happening this first time joining every Monday, 6 p.m. This is great, right? Come on every single Monday. More than welcome. Any questions you have, we get into it. I'd like to think that past, future, present clients are joining, real estate agents are joining, random folks all over who just want to get their questions answered about mortgage, real estate. We talk about real estate investing. We talk about all kinds of different stuff. So hopefully I'll see you in the future. I've got some really good suggestions for bringing on underwriters, bringing back an appraiser that I had on prior. I've done some collabs with my buddy Kyle Seagraves, Win the House You Love. So yeah, my plan is every Monday, 6 p.m. Pacific Standard Time. And I really feel like it's beneficial because we can go back and forth, get your questions answered. And if, you leave a comment on a video and I don't see it for 48 hours and then I respond to it, it wasn't really what you were asking. And then, that takes another 24 to 48 hours. That's just inefficient, right? Let's just hash it out right here. You want to know what the rate was on a 25% down investment property? We got it. Bam. Good to go. Yoshi, thanks for joining. I'm turning my primary residence into a rental property. Would like to refinance into conventional and buy another FHA 203K. How should I do it? This is a super common question. And I think that what people, for whatever reason, they're trying to refinance out of an FHA just to have the ability to buy more FHA. But FHA is good if you've got not so great credit and 3.5% down. And besides that, when somebody's buying their second or third property, it's usually not best to go 203K, or I'm sorry, FHA. And you're saying buy another FHA 203K like you've done the 203K before? We talked about that right at the beginning, about how I thought the program was not really the best. So if you've done it before, tell us your experience. Tell us if it was good. My first thought is, if you're buying a new primary and you want to put 3.5% down, if you've got 5% and your credit's good, do a conventional 5% down. Probably better. The tricky part for you is if you're trying to buy that primary soon, you can't necessarily refinance your current as a primary and then buy a new one as a primary. Banks are going to look at that and go, Yoshi, what you doing, bro? This is mortgage fraud. They're not both your primary. And so if you refinance conventional now on your current property because it makes sense and it's your primary, and then a year from now or 9 months from now, you decide to move and buy a new one, then you're all right. But I would look and see if 5% down conventional serves you better. It's a better looking loan product for your next purchase. Depends on what type of work you do. If you guys are working a W-2 job and it's salary, and you went from $5,000 a month in 2019 to $10,000 a month in 20, and it's, your salary went from whatever to 70 and hers went from whatever to 50, and you've got like set salary $70,000 a year, her set salary $50,000 a year, we can use that right away. If it's something that's variable, you guys are real estate agents or self-employed, and it's variable in any way, a lender's going to look at 60 and 19, 120 and 20, and then the year to date for the first 4 months of 2021, and they're going to take a 28-month average. That's the only way a lender really knows how to get an idea of what you're going to make in the future, is look over the last 2 years and take an average. They're not going to take last year and go, oh, great year, we'll give you that. If you've been self-employed for more than 5 years, here's a hack. You have a lender run LPA, Loan Product Advisor, versus DU, which is Desktop Underwriter. It's a Fannie versus Freddie thing. LP will allow you to just use last year's taxes, only if it's been more than 5 years self-employed. Let's say you're a real estate agent. You have those numbers, 60K in 19 and 120 in 2020. If you've been doing it since 2015, all good. We got to show you've been doing it for more than 5 years. Then we use just 2020's tax returns. We don't even put 2019's in the file. We don't want to know. And then as long as your year to date this year is that $10,000 a month or better, we're in good shape. If it's less, Uh-huh. Nate and Jess, my like my mods in here, hit the like button. I appreciate that, you guys. You let them know. Hit the like button. I wonder how many likes we got. How do I even go look at my own video? I don't know how to see it on YouTube. I'm just streaming this thing through StreamYard, which is pretty friggin' cool. I got to tell you guys, if you guys haven't checked out StreamYard, for me, who's a simple dude with not a lot of tech skills, I like it. I like it because it's super, super easy to use. Okay, I'm getting the Home Ready program with Lennar. I asked the loan officer about using DPA programs. He said that he'd have to be, and not conventional, which would be higher MI. Is that true? Depends on your state. Down payment assistance programs are by state. Generally, the housing authority, like in California, we've got Cal HFA, Housing Finance Authority. Is that who they are? And they've got a couple different programs. Golden State Finance Authority, they've got a program. And so they're state run, and that's why it varies from state to state. The down payment assistance programs that are available, I would ask you, because Home Ready is like a 3% down. It's conventional. And if you've got it, you're more than likely way better off that 3% down Home Ready than you are using down payment assistance. Down payment assistance is more expensive. Fees are, and I'm just saying generally, right? I don't know. There might be a down payment assistance program in Tennessee that's great. In California, you're paying a higher rate. You're paying more fees. And what's going to happen is I can't tell you how many people contacted me in 2020. Hey, I want to refinance. My property's gone up this much in value. You bought for 400. You borrowed 105% because of how the down payment assistance program was structured. And they gave you some money towards down and some money towards closing costs. But you borrowed 105%. So you borrowed $420,000. Plus you paid an upfront mortgage insurance. So you owe $427,000 on a home that you bought for $400,000. So even though it went up all the way to $430,000 since you bought it, you can't refinance. You don't have enough equity. That's the stuff that really makes me want to shy away. But in most states, there's FHA and conventional. And if you're saying that it would be higher MI FHA, which on conventional, the MI varies based on credit score. If you got great credit, the MI is low. If you got not so great credit, the MI is high. I would say if your credit is good and you have the 3% down Home Ready all day, every day. Lennar, in most builds that I've seen, since they own Eagle Home Loans, it's going to be Eagle Home Loans that's doing the loan. Do 3% down Home Ready and see if Lennar is going to give you a lender credit for using their lender, Eagle. They own that lender. So they'll give you incentives for using them. Use that for leverage and ask for some credit to cover the closing costs. And you just put the 3% down and do Home Ready. It's going to be much better. Much, much better. I bought the rental I've lived in for 8 years. If I sell within the first year, am I still liable for capital gains tax? I bought the rental I've lived in for 8 years. The capital gains, I'm not a CPA, consult a CPA. I'm just a guy on the internet, mortgage broker, license number 1088993. You have to have lived in the home for 2 of the last 5 years. 2 of the last 5 or 3 of the last 5? Something like that. And so if it was your primary residence and you lived in it for 2 of the last 5 or 3 of the last 5, whatever the rule is, you're exempt from the first $250,000, or if you're a married couple, the first $500,000 of capital gains. I'm trying to figure out your question because it says rental, but then it says lived in for 8 years. If you're living there, it's your primary residence, and you sell, you should be good. You should be exempt from the first $250,000. And from my understanding, You could move out and be gone for a year, but you still, as long as you live there for 2 of the last 5, you're good. Talk to a CPA though. I'm just some dude on the internet. How long do you think this alleged lumber shortage is going to spike costs for? Who knows? If you guys don't follow the Uneducated Economist, that dude is a good follow on YouTube. He's got a good channel. He works in a lumber mill or something to that effect, some sort of retail capacity for lumber. Dude is super, super sharp with all things economics and has a finger on the pulse of the lumber industry because he works in it. So go follow the Uneducated Economist for some great stuff there. This is a great question. I get this, Ludi, like more often than you can imagine, where they're like, "Hey, I don't want to transfer title to my LLC because there's a due on transfer clause, and they can call my whole loan due." I've transferred multiple properties into LLCs. I've had clients transfer properties into LLCs hundreds of times, hundreds, because I've got tons of investor clients I work with that have done tons of loans. Every single time they close in their personal name and they transfer it back into the LLC. And then it's sitting in LLC, they refinance, they got to, close in their personal name and transfer it back to the LLC. Never, ever, 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 ever have I ever had it, a lender call it due, ever. So I think that's probably an old wives' tale. As long as you're paying the loan on time, I think the lender's cool. They're all right with you. So you should be all right. How are points calculated? There's not a true calculation. You just have a rate sheet. So if you're buying a property for $500,000 and you're putting 20% down, so it's a $400,000 loan, like you said. 3.75, 2.75. Let's say the par rate for this scenario is 2.83. And then it cost a half a point to go to 2.75. And then it cost 1.2 points to go to 2.625. I've seen more often than not on rate sheets nowadays, it's just not beneficial to buy it down. Lenders are not, and this is the thing about lending. It might be something today that's different 3 months from now and different 6 months from now. The lender is going to basically change this rate sheet depending on what type of rate they're trying to sell. I've seen it on wholesale rate sheets where I can get 2.75 for less than I can get the 2.875. Like they're steering you towards a certain rate because they've got, so many available or something. So I'll show you. I think that's Chinese. I can't read Chinese. So I'll just call you. I don't know. I'm not going to make up a name. But let's see if I can Control plus, Alt plus. How do I? Oh, shoot. What'd I do? How do I back out? That was fun. I went a little bit too crazy with the zoom there. All right, so 2.83. It's a $400,000 loan. 0 points. Then you pay about a half a point to go to 2.75. You pay 1.2 points to go to 2.625. And go to 2%, but you pay 5.23 points. None of these really make any sense. I would never tell somebody to pay $5,000 to go to 2.625 and save $43 a month. Like that's that spread right there, $43. No way. Just doesn't make sense. And so I'm not seeing many scenarios right now where it makes sense to buy points. 2.830. Find a broker, get that sweet smoking 2.83 with 0 points on, this is a $400K loan, $500K purchase, 20% down. All right. Not an offer. Just an example. Random example from a random dude on YouTube. NMLS number 1088993. I'm forgetting. I'm getting old. Do you think it's worth doing a physician mortgage loan as opposed to conventional? It's just a conventional loan. The physician mortgage, another hot tip for everybody. It's marketing. There are some lenders, and here's the thing. Here's the only thing I've seen that's a true benefit of a quote unquote physician mortgage. They'll calculate your student loans different, or they'll exclude them, or something to that effect. But I can tell you from inside the belly of the beast, a lender I used to work for did tons of promotions. I won't say tons. Every lender does this, so I'm not going to pick on the lender I used to work for. Every lender does this. State workers, nurses, doctors, physician loans, like you see. We've got these special programs. We offer this discount. We offer that discount. It's just marketing. It's a conventional loan. True that some of them will have a specific way they help you out. They calculate your student loans different or something like that. But it'll be funny. You'll talk to a direct lender that's like, hey, we got this physician loan. It's a great deal. It's this and that. And then you talk to a mortgage broker and you're like, wait, your conventional loan is better than the physician loan, but this is a physician loan. This is something special for me. Marketing. All right. I can't reach. I mean, this is live. I can't take that back. I just gave you guys all a secret. I have some turkey meatloaf and some mashed taters. All right. Told you guys I'm going to keep it real. And that's it. Thank you, Linda. Appreciate you. First-time buyers in northern New Jersey. In contract, just got loan commitment from a mortgage company. $580. Loan amount $522. Conventional. I don't know if that's the best you can get. Depends on who you're working with. $580. %. $788. Not an offer to lend. Just a random dude on the internet. May or may not be running some pricing at the number one wholesale lender in the country. Conforming conventional 30-year fixed 2.834, 0 points. Ole. Go to greatmortgagebroker.com. Fill that out. Put something in there about in contract. Follow Matt the Mortgage Guy. Help me, please. They better take good care of you. If they don't, I'll bust them up. You can do better. For sure. Yeah, in contract, just got loan commitment. I'm not a big fan of like somebody switching their lender like midway through, but if you just got in contract, you just got started, I mean, that's a big loan amount. So the difference between 3.25 and 2.834 is $117 a month. That's a lot of money for your family. And just because some lenders have fancy brick buildings, a branch manager, a district manager, a regional vice president, a marketing company, all these people, doesn't mean you got to pay $117 a month more. Local mortgage broker, set you up. Save $117 a month. I'm rooting for you. Greatmortgagebroker.com. Fill that out. Or Matt at mattthemortgageguy.com. Shoot me a personal message. I'll forward you to somebody that will get you dialed in quick. This is a good question, DM. July of this year. It's coming. Prices are going down by 40%. You guys can clip this part of it and just let everybody know. If the house is priced at $400 It's going to be on sale for 40% less come July 2021. So what's that? 160 off, 240. So 6-8 weeks coming crashing down. All you got to do is like check out other YouTube channels. We got plenty of guys like they've made 14 housing crash videos in a row. All right. That was a funny joke. I realize I'm not a comedian. I'm just a mortgage guy. I don't see it coming at all, ever. That might be crazy to hear, but home prices might steady, might be 10% this year, 7% the following, 4% the year after. But a 20, 30% correction, I would not be surprised if we never, ever got it. I mean, what's going to fix this supply issue? We've got no houses. We built 5.8 million in the last 10 years, and we needed like 20 million to be built based on demand. We're just going to fix that $14 million gap overnight. Like some button's going to get pressed, and I don't see it. I think we just print a bunch of money. Inflation's here. It's real. Gas is going up. Minimum wage is going up. Price on everything are going up, including your house. 12 so far. Man, I'm getting old. What were we talking about? Was it? I scrolled up, Darren, to check on. You were talking about the appraisal. All right. I missed whatever that's connected to. Thank you kindly. $10 super sticker. Might break a record tonight. Got 3 super stickers. Appreciate the heck out of you guys. Just for that, I'm going to go another half hour. Mondays, just so you guys know, I work about 14 hours, and I end it with this 2-hour or so live stream, and I couldn't enjoy it more. This is super fun. Talking to a bunch of folks, answering a bunch of questions, bunch of live feedback and back and forth. I really enjoy it. Monster, what's up? I lived in the rental and bought from the landlord. Oh, so you bought the rental. I see. So it is your primary. You lived in it. If you sell it while we're still able to, defer capital gains, you should be able to sell it and not pay the first $250,000 in capital gains. If you're married, then you should be able to defer the first $500,000. So sell that puppy. Take those capital gains, tax free. Just go redeploy it somewhere. Thank you kindly for the comment. I appreciate it. Matt, what do you think the best place to park money for the down payment? I think anywhere. I mean, for me, honestly, when you're putting away $1,000 a month or $1,500 a month or $2,000 a month, some of these high yield savings now are like 1%. I don't know. I mean, I guess you'll earn an extra $78 versus like if your current bank or credit union offers you 1/4 of 1%. But still, it just doesn't move the needle enough for me to really care between the two, right? And maybe I'm doing it wrong. Maybe Graham Stephan would slap me across the mouth. I've got some money in his Yada bank. Graham Stephan's part owner in that. And that's pretty cool. That's like that lottery-based bank where based on your deposits, you get lottery tickets. I think I won 40 cents this week, which is better than I did in my, like, I've only got, a few $1,000 in this thing, and I've already gained like $23 in interest. So like it's averaging 1.5 or 2%. But yeah, I would just park it in some sort of high yield savings. I wouldn't want to put it in the market or anything like that. Then you're going to get beat up like Meet Kevin did today, where his Tesla stock went down 7%. And that guy was like crying and drinking on his live stream because stocks were red today. High yield savings, final answer. And more important is the rate at which you're saving it. $1,500 a month, $2,000 a month, whatever the plan is, stick to that. That's the most important part. Whether you're getting 1/2 of 1% or 1.5% is not the thing that's going to really help you get to the final goal. The way to get there is say 2,000 a month, no matter what. No matter what I got to sell on eBay, no matter how many, meals I got to skip. Top ramen. Is there truly like a lumber shortage, or is it a supply chain issue? I don't have any idea. I'm totally guessing. I do not have any idea. So you need to cut down more trees. That's the deal. All right. I think there's some trees in California you can cut down. Start a lumber company, Nate. Can you get homes with low down payments, or sellers consider that? They do. I'm looking at some of the offers I got accepted over the weekend just to see if I got real life examples. 20% down, 5% down, 10% down. Those three I took notes on are all conventional. 3.5% down FHA. We just closed. We're closing tomorrow. I've got a VA, 0% down in contract. What I will tell you is that down payment assistance is like a long shot. It's not even a half court shot. It's like a 3/4 court shot behind your back. That's going to be tough. But 3.5% down FHA, 3% or 5% conventional. What I've told people is that the down payment isn't necessarily like the part that scares the seller. What the seller is concerned about, look at this guy, little Math and Mortgage guy. People love these pens. Do a loan with us. I'll send you a Math and Mortgage guy pen with a little guy on top. Sorry, I get squirrel, get sidetracked easily. What I tell people about low down payments is the seller's less concerned about the low down payment. What they're concerned about is you're offering $360. It might appraise at $340. Do you have the $20,000 to make up that gap? If you're putting down 3%, the chances are not very likely that you have that. If you do, have your agent say that. Hey, listen, I only want to put down 3% because I want to conserve capital because X, Y, and Z. But look, I've got $42,000 in my bank account. I'm willing to make up an appraisal gap if that comes up. In that case, I think you'll be fine. And really, that's back to my point. Great agent, great lender, giving the seller confidence that this deal is going to close and that the buyer has been well informed on all the different scenarios, the pros, the cons, whether it appraises at this or it appraises that. We're going to make it to the finish line. That's what they want to hear. So when I call them, I give them the warm and fuzzies. They know we're making it to the finish line. That's why my buyer's offers get accepted all day, day. San Antonio, Texas, we're giving 5% down and our rate is 3% home ready conventional. Yeah. Do that. Do not do down payment assistance because who knows what that down payment assistance is, but home ready is just a conventional loan. And it's reduced rate, reduced mortgage insurance. I like it. I'm down with that. You're talking about they're saying it's going to crash the last 3 years. Here's a fun exercise for everyone to do. Type in Google, housing market crash 2014, housing market crash 2015, housing market crash 2016, housing market crash 2017. I was going to make a compilation. It was going to be the funniest video ever. If I didn't have a thriving mortgage business with 45 deals in contract, I would have all the time in the world to make all these funny videos, but I don't. So, or I do. So I don't. I've got this mortgage business to take care of, but every single year they've been saying it forever. And this is the $1 million answer. It's hard to crash with no inventory. With no inventory and tons of demand, it's near impossible to crash. We could have an extra million homes come on the market and we could have interest rates go up 2% and have demand shrink by 50%. We're still not going to crash. We're that far off. We're that far imbalanced. Supply, demand. Rates go up, supply or demand goes down. Homes come on the market. We're still going to be here, right? We need to be here for a crash. Right now we're here. Some things happen to supply side and we come here. Things happen to demand side and we come here. Maybe here, maybe here, here. Balanced market. maybe 3 years from now. Getting here? Muy unlikely. DM, I appreciate you. Super sticker number 4. I don't know what the record is on this live stream, but we got to be getting close. A few more super stickers, a few more super chats. I'll make my boys so proud of their papa. Do you suggest buying my home in LLC or my name? I only want to live in home for 1 year, then rent it. Can I change the deed? Thank you kindly. Most every single lender out there who's lending to you and giving you a conventional loan is going to make you buy it in your personal name. Personal guarantee, your personal income to qualify. Then you just grant deed it into the LLC. And so sure, do that. Throw it into the LLC. And the answer to your question, yes, you can change the deed. Just grant deed from Chad Gomez to Trace Pescados Properties or whatever the name of the LLC is, right? Super easy. Most, trust attorneys or whatever attorney drew up the LLC can do it. Or there's, sacdeeds.com in my area. They deal in deeds and helping you out with that. So super common, super easy to do. See, that's why I got Nate's like my sidekick on this channel. He's always got the best answers in here. So, reverse tier savings accounts. Tell us more about those. Reverse tier savings accounts. Tell us more. That's in response to the question about where to park the down payment money. Oh man, Simon, you're back. I thought about you today, bro. I'm gonna do it. Here's the honest truth. I want to make the non-QM video. Non-QM loans are more difficult than conventional loans. And if I make a video, people call me about those products. So I'm going to get 50 phone calls, 50 inquiries looking for non-QM loans. I don't want to do them. Is that bad? I'll make the video though, Simon. I got your back, dude. I'm going to make it on a couple specific products because there's tons. I'm going to make it on bank statement product and a debt service coverage ratio product. And those two are super straightforward. It won't even be that complicated of a video. It's going to be fairly quick. And I've got a few of those in process, and they're not just a little bit more labor intensive. Not even for the client. Not like you've got to provide a bunch of extra stuff. Just the lenders that offer those products are like not super tech savvy and not super easy to use systems. So it's like tretching through some of that stuff. Yeah, but I got you, dude. I think I promised you within 10 days, and it's probably been 5, 7. So it's got to come out this week. All right, Simon. I promise you, dude, I did not forget. I was thinking about it today. I was thinking about how do I make a good educational video without getting a bunch of inquiries. Because I'll tell you what, man, I make videos on jumbo loans. People call me about jumbo loans. So I'll take those all day long. All right. From San Diego, California. How you doing? Got a couple clients down in San Diego recently. Your guys' real estate is expensive. Hypothetical. If I get out of forbearance now, I have $14K due since November of 20 and $100K left on my currently $2.875, $600,000 house. What rates am I looking at? You only owe $108? If you owe 108 and your rate is 2.875, I don't even have to do any math. You could probably get it to 2.5, but it's not worth it at that little old balance. Because let's say you were saving 0.5%, 2.375. 0.5% on 100 grand is only $500 a year. Title fees, lender fees, just like on refinances, there's some tax that goes towards low income housing. All that stuff, bare minimum, you're paying $3,000 in costs. So it's a 6-year break even. You don't want to mess with that. I mean, maybe if you're looking to do like a 15-year because you're trying to pay it off quicker or something, you can get to like 2% on a 15. And then in that case, maybe you're saving $1,000 a year in interest. Even then, man, I'm just not a big fan of the cost of the refinance for loan amounts that small. That's my final answer. Sticking to it. Brother John, you're 53. You get retirement for life with the state. Jump into mortgage and have some fun. This is a question I've been getting a lot lately, and it's a good question without really a lot of good answers. Because the more I've looked, and I added like a junior loan officer to my team, and it kind of went back and forth with them about other places where it might be better to start to get some more education. Everybody I know in mortgage kind of learned through doing. There's no really good training programs. Well, I shouldn't say there's none. The companies that offer the best training programs, you get paid next to nothing. Junior loan officers on my team talked to a direct lender in town where the deals that they brought in personally, they made 10 basis points. So if you brought in a $300,000 loan, you get paid $300 on that loan. When you're starting off, you're really only going to do a handful of loans per month at max. So if you brought in 2 loans a month, which is probably all you should expect being brand new, and they're only paying you 10 basis points a loan plus minimum wage, you're not going to be, I mean, for you, if you've got retirement income and that's sustaining you and you're just kind of figuring out whether you like mortgage, maybe that's fine. Maybe $1,000 a month or $2,000 a month is okay. But yeah, I'd probably hitch yourself to somebody who's established, somebody who's been in the business for a long time and can coach you up, because a year of mentorship and coaching is going to be invaluable. And then you kind of decide, because maybe you get into it and you say, hey, I'm going to go work for a branch. It's a high producing branch, and I'm going to be loan officer assistant to their number one producer. I'm going to help him collect, conditions on files. I'm going to help some of the communication. And then you learn through doing, assisting. I've seen people succeed that way, where 2 years of high level assisting, you just get all the experience from that. Because starting off and say like, I'm just going to become a loan officer day one, let's go. You're going to know next to nothing. And it's going to be impossible to learn if you do 1 deal this month, 2 deals next month, a deal the month after that. Like if you've got 14 deals done in the next year, like you're going to learn next to nothing, versus a team. We're doing 350 deals a year. And you get to see all those because you're assisting in every single file in some capacity. That's how you'd learn. And then, if you get the right person, you tell them the plan. Hey, I want to come in, learn. I want to help you out. And I don't need a bunch of pay for it. I just want to be compensated, fairly, and then go off and do my own thing. If I decide that I like it, I want to pursue it as a full-time career. I think that's the best bet. Final answer. Why LLC for a home? People put their properties in LLC just to protect themselves liability wise. If you personally have $5 million in assets and you own a rental property where somebody slips and falls and sues you, if ABC Rentals is your LLC, owns that property, it shields you personally from liability. And so that's why people do that. They're going to own properties in an LLC where, there's 40,000 equity in that one house that's in that LLC, or there's 100,000 equity between three houses they own in that LLC. And that person who's suing for whatever reason, they got bit by the neighbor's dog in a fourplex or something, and they're suing you. They can't come after you personally. $5 million in assets. Canvas Credit Union. All right. Canvas Credit Union. I'm interested now. It better be good. Oh, 12-month CD? Those things still exist? I wonder if they're any good. Got you, Simon. Don't worry, bud. Got your back. Do you have to wait 2 years with QM loans? Wait 2 years for what? Yeah, AT&T pays a pretty good dividend. Got me some AT&T. I guess it depends too on how long your that time horizon is. If you're saving for 9 months and CD's out of the question, if it's 12-month CD and some of this stuff is just, probably more pain than it's worth. But if you're, got a 4-year savings plan, then maybe there's other options available. At the very least, you should have umbrella liability insurance for rentals. Yeah, I think best case you got them in LLC and you got the umbrella. But yeah, you got a couple $1 million umbrella policy. You sleep pretty good at night, knowing that if something happens, someone comes after you. You got some insurance to back you up. They're not going to sink your ship. My guess, Eamon, is that you're asking about 2 years with non-QM loans. Are you saying do you have to wait 2 years to refinance out of it? Because a lot of non-QM loans do have prepayment penalties, where if you refinance within 1 year, 2 year, 3 year, whatever the prepay is, then you've got to pay a prepayment penalty. So if that's the question, on some of them too, from what I've seen, you might get a 5.25% rate with a 3-year prepay, 5.75 with a 2-year prepay, or 6.25 with a 1-year prepay, and you pick. Do you want the lowest rate, but you're stuck in it for 3 years, or you want a higher rate and you can refinance out of it in a year? Oh, 2 years to qualify. Depending on what type of loan you're getting, some non-QM loans are just based on the property. And the only thing I care about for the client is down payment and credit score. You got 20% down, you got 700 credit, or even lower in some cases. The property is going to be a principal, interest, tax, insurance payment of $2,000, and it rents for $2,400. That's all the lender needs for the debt service coverage ratio loan. If you're doing a bank statement loan, then some of them want 12 months of bank statements. Some of them want 24 months of bank statements. And you show them those. They take an average. They minus out expenses. And I've got a cool lender that I can send your bank statements to. They'll spit out exactly what they're going to give you in income. They use that income to qualify. What's up, Charles? How's it going? Thanks for joining. Are most people stretching their loans? Got pre-approved for $680 and earn $150K gross, no debt with 5% down. That's probably about right. I think somewhere they talk about 4 times your income. So buying $600K, $680K with 5% down. That's probably a stretch. That's a chunky payment, Charles. So yeah, and this is all market dependent, right? I can't tell you like, oh no, Charles, try to find something 550 and below. If you live in a market where, a beat up fixer upper 600,000, um, uh, then, so be it. I think what you just want to do is, really dig into principal, interest, tax, and insurance, like I did on an earlier little scenario, at that 680 with 5% down. Is that something that you're comfortable with? For somebody who makes 150 grand a year and has no debt, you're probably financially responsible. And so, 12,000 a month, you take home 9. I don't know what the tax and insurance are in your area, but 680 with 5% down, I'm just going to ballpark and say that total payment might be 3,500. That might be low, but that's getting near 40% of your take home pay. But it's personal preference, right? You might be expecting to make 250K in the next 5 years, 10 years, and your income's going to go up and your mortgage payment's going to stay the same. So 3,500 a month might be a little bit tight now, but over time it's going to become more bearable. But just at first glance, my honest opinion is like that's probably about, as much as your budget's going to allow, even though you have no debt, right? And that's important too. If you were somebody who makes 200,000, but you've got $2,700 a month in debt payments, you'd be way worse off than somebody with zero debt who makes 150. So, really only a question that you can answer. I guess what your question you wanted me to answer was, people I see making 150 a month, what are they buying? Between 500 and 600 is probably what I would guess, just off the top of my head. And that's market dependent too, because in my market, the entry level, folks are making 70 to 110, and they're buying 300 to 500. People that are making 150 are probably buying 5 to 6. People that are well-to-do, making $250,000 or more, might be buying more. I'm a very conservative cat. So I got a little mortgage in the little neighborhood that I grew up in. Thank you. I appreciate that. Best mortgage Q&A on YouTube. All right, you heard it here, guys. Got a bunch of friends that do similar stuff, like Kyle Seagraves, Win the House You Love. He's the GOAT. He's the GOAT of Q&A on YouTube, I think. But if I'm catching up to him, you better watch out. USDA loan, 100% down or 100% financing. That's cool. You're in good shape. All right. Offer accepted. I'm telling you, I told you guys, offers are being accepted. I can feel it. Before we get off of this, I've gone 2 hours. If you haven't smashed the like button yet, do so, please. Let me see how many likes we got. We still only got 25? This can't be right. We had 25 earlier. You guys haven't been smashing the like button? Where's my dude at? Where's Nate at? Have you been telling him to smash the like button? Okay, we're at 40. We're at 40 likes. You guys have done all right. I appreciate you guys. Join me every Monday at 6 o'clock. I'm going to keep doing it until I get tired, or until people just stop showing up and just tell me to stop doing it. Let me get a couple more questions answered. Offer accepted, 305. Conventional loan with 10% down. PMI should be 130 a month. Should I pay? Don't mess with the piggyback loan. Just do the 10% down. 138 a month. I wonder how your credit is. You got good credit? That's another thing people don't realize, is that different lenders have different mortgage insurance premiums. I work with lenders that have smoking MI, but it depends on your credit score. Let's say your credit's 705, 138 a month. I'm going to look real quick, just 'cause I'm curious. If you've got really good credit, oh my gosh. Yeah, if you got really good credit, the mortgage insurance on that 305 with 10% down, is this right? 305, 10% down is like $38 a month. $38.89. But let me see. Let me type in 705 credit. Because maybe you're not in that 780 world. The piggyback like 80-10-10 on that purchase price, it's going to be a pain in the butt, not going to be worth it. Just, bite the bullet, pay mortgage insurance for a little while. Even at 705 credit score, I'm looking at a $75 a month mortgage insurance. Call a broker. Most people with equity, most people honestly don't do anything with it. It just sits in their home, and that's not a bad thing. There's plenty of people that are like, everyone's cashing out all their equity. The sky is falling. This is bad news. First and foremost, 2020, tons of equity is pulled out of homes, but not anywhere near as much as in the crash. And the lenders are capping it at 80%. They're doing it responsibly. Everything's fine. Everybody settle down with that talk. People are improving their homes. They're paying off credit card debt. They're buying investment properties. They're buying second homes. Quite a few people, the coolest stuff for me is somebody's had a mortgage for 7 years and they do a cash out refinance. They take $90,000 in equity and they lower their rate from 4 to 2.875. They got the same payment, but they got $90,000 in cash out. So their monthly payment doesn't change, but then they take that $90,000 and they buy a second home they've always wanted to buy. And they put 20% down on something that's $400,000 that they can take their family to every year. Stuff like that, right? Or I've got some where people have home equity lines of credit, paying off the first, paying off the second, taking $80,000 in cash to pay off credit card debt. And that's I love paying off credit card debt with home equity. The only thing that you need to be careful of is don't go rack it up again. Once the credit cards are paid off, try to never, ever go down that road ever again. If you know that you're not responsible enough to pay it off every month, then just do away with your credit cards. I know that I love 1.5% cash back. So everything I do through the business, I charge it on a credit card and I pay it off every single month in full. But I get 1.5% cash back. And plenty of people love the cash back. If you're somebody who keeps a balance on it every month and it goes $2,000, $3,000, $4,000, $5,000, $8,000, figure out why. If you're making $7,000 a month and spending $9,000, that's why. Get that stuff paid off and then never charge it again. That's something that's probably not for a mortgage channel, but it's for a finance channel. Of the same way that you can snowball in reverse and get further and further into debt, you'll see your wealth increase when you have no debt and all you have is appreciating assets, where your rent's going up on your rental properties and your equity is going up on all the property you own, and you've got no debt payments. And so every month when you have an extra 500, 600, 1,000, 2,000, whatever the number is, right? It's being invested in the stock market, or it's being applied towards principal on loans, whatever it is, right? You're going in the right direction and you're snowballing that way. That's fun. Hopefully it's $38. I mean, I wouldn't be surprised if it was 138. I mean, there's some lenders out there that they've got some nice offices, bro. They've got like a branch manager that gets a big override. They've got a district manager that brings bagels every Monday. A lot of people getting paid. When you're paying $138 a month, make sure you're not. Good luck with this one. Get Biden to build more homes. I've got the hack. I've got the answer. Incentivize people to sell. Incentivize them to sell to owner-occupied buyers. Tax incentives, no capital gains. if you sell to owner occupied. Oh, Steve Dow. There you are, my man. All right. Non-QM loan programs coming soon. We got you. We got you. I'm going to talk to Steve Dow. I've got a couple non-QM loans in my pocket. Steve Dow's got some. Where are you at, Steve Dow? I got you somewhere on my desk. I've got some of Steve Dow's programs somewhere. My desk is a mess. Maybe I'll bring Steve on. We'll talk about him because I know people are looking for him. Velocity. That's the name I was looking for. Velocity. That's the company you're with, right, Steve? All right. Sorry, had a brain fart. It's been a long day. I've been at it since 7 a.m. It's 8 p.m. 13 hours. Do credit scores drop 50 points after signing up for a mortgage? No, not even close. Your credit score shouldn't drop much at all. All right. How soon after close can I refinance? 350 at 3.625, 95 LTV. Yeah. I mean, here's the thing too. Whether it's 6 months after you purchased or whether it's 6 years after, the only thing to look at is cost versus benefit. If you have a $350,000 loan and you go from 3.625 down to 2.875, that's 3/4 of a point. 3/4 of a point on 350. Let's call it $2,700 a year in interest savings. If it cost you $3,000 to do it, and you're going to save $2,700 a month, and you're going to stay in there for longer than a year, it probably makes sense. So then you look into a refinance. Find a local person you like and trust. Have them send you a scenario, like the scenario I showed earlier for purchase. I just show people that, and it's about as straightforward as it can get. It's literally a loan estimate. And it says loan terms, principal, interest, tax, and insurance. And you'll see your current one, right? Where it's, let's just call it $1,980 a month. And then we look at it and it's going to be $1,770 a month. You're going to save $210 a month. And then you look box A, B, and C, total loan costs. It's going to be $2,852 in total loan costs. You do some math and you say, okay, I'm going to break even in 14 months. I'm going to stay here at least 14 months. It makes sense for me to refinance. Okay, let's refinance. Press play. And that's really all people should be doing for refinance. I mean, trust me, I work with some engineers. I work with some guys that analyze the bejesus out of refinance. But for me, it's just cost versus benefit. How long until I break even on the cost of this refinance? And then how long do I plan to stay? It doesn't have to be super complicado. All right. I think I'm going to wrap this up. I've had enough fun. I appreciate everybody. Jump on next Monday. I've got a non-QM video coming for my buddy who's been asking for it. I'll get Steve Dow on. We'll chat non-QM and some of those programs. Those are good for self-employed folks, for folks that don't fit into these nice little buckets. So thanks again for watching, everybody. Every Monday at 6 p.m. I'm going to keep doing it. And the hope is that the more I do it, the more momentum we get, the more people we get to join. When we have the interaction and people are asking questions and I get folks in the comments who are helping out, like Nate and Jess, thank you for getting in here, not just asking questions, but answering questions and giving feedback. You know, the more discussion we can have back and forth, then we can get some feedback from, somebody in Illinois, somebody in Florida, somebody in Texas, somebody in New York, and we can all kind of just, consolidated mastermind, whatever the heck you want to call it, right? I enjoy it as much as you guys do. So keep tuning in. I appreciate it. I'll see you guys next Monday. Thanks for watching.